Welcome to this week's Cattle Call. I'm Susan Littlefield on the Rural Radio Network. First, a quick apology to many of our ranchers and cattle producers that look for this report midweek, but we had technical issues, which happens when you got rural internet, so I know you'll all understand. But I think it was meant to be that we waited till a Friday to do this report. You can see Brad's already smiling about it as Brad Kooima joins us. He's with Kooima Kooima Varilek out of Sioux Center, Iowa. Let's talk about this leverage. Is that the name of the game this week?
I sure think so, Susan. And thanks for having me on. And it's too bad Wednesday didn't work out. It was like going through a McDonald's drive-through, right, where you get in every fourth word.
Yep.
You know, and we can all pretend like we were going to look smart on Wednesday. I'm not sure that I would have or not. But leverage. We've said it on. I've said it on this program. You and I've talked about it. You know how there's. I've talked about it with some of these PhD university guys too. That. There is such a fine line between too many and not enough. There's this whole discussion of how much negotiated trade do you have to have? How much captive supply cattle can you have as a percentage without impacting the market? Seemed to be a theme here that within at least NCBA cattle organizations the last couple of years. And it seems to me like, we just lived through we're in the middle of a situation like that. We're still killing big. 127,000 yesterday again, 126 the day before, 127 the day before. I mean, so to say we've run out of cattle doesn't hardly seem like the right thing, but the difference is the word you used. I think we got an environment where the producer is very current, pulled forward, in my opinion, 30 days, been that way since the high priced corn, and then a brutal winter. And now we can say no to a bit if we don't like to, because we are pulled forward that way. So yeah, really, really fun. Very front end loaded market yesterday and today. They expanded the limits, and I was kind of torqued off about it, Susan. In fact, I complained to the CME. I said, "Why do you do that? We don't need more volatility. We don't need to have higher margin calls." But it was kind of fun that the first time we blew past it was on the upside instead of the downside. How about that?
It was nice to see for these guys, especially like you said, with the struggles they've had. How about the cattle producers in the South? I mean, they took a huge jump this week on the cash numbers.
I don't really keep track of these sort of things, but I think I'm safe in guessing that that's never happened before. Last week, basically at least the trade to the majors was basically 171 down there. And then they finished last week like an exploding firework, 180, trade as high as 180 late in the day, and in some spots in Texas and Kansas. Crazy. The North, basically had, there was some 183 and then 4 and then 5 bid. I would say there was cattle traded at 185, and then there was some cattle traded at 187. I know that there was a few cattle traded to a small regional as high as 190 up here in the North yesterday late. So it looks like we're kind of maintaining that $8 to $10 spread where the North is still premium to the South. Really glad to see the South step up and catch up here. In fact, almost really ahead of the North yesterday. So that's great, because the futures market will trade against whatever the lowest common denominator or where the poorest price is. So, we're still looking at, even with a big blast, we're still looking at a futures market that's discounted to even the lowest cash in the country right now.
What are your thoughts on how demand is? I mean, we're past Memorial Day now. We're into the heart of grilling season.
It's a great question, and it's where I'm trying to, that's where I'm trying to, get my head wrapped around it. When two things, I think, when do we actually price our way out of competition? And there was a little bit of dialogue about that at the beginning of the week with some of the meat merchandiser stuff, talking about, how competitively priced pork and chicken is compared to beef. There are some, like we kiddingly have talked about it, if you're going to, let's bet on the Nuggets Heat basketball series, as if I could care. But, we bet a steak dinner, right? You don't bet a fourth of chicken or something. As you go into this grilling season, I think you're still going to see it. The way we're killing cattle, I think you'll still see it. Boxes are up another $2 today. Now, so it's not in the here and now, but let's be realistic. This is this window here within a week or two, give or take, where two things happen usually. Almost always, with great regularity. You'll top the box beef market somewhere in this window of time as you get close to Father's Day. usually a week or two before Father's Day. So we're right in that window. And the other thing that always happens is that you bottom the weight. You just get more days on feed on these calf feds, and you'll see a little more weight coming into it. So, as I look at it, it sure seems to me like the June thing, this kind of, I don't know, the mold is made for June cattle. I don't think that I think we've pulled so many cattle out of June into May and killed them already that I don't see that the supply is a big worry to me, at least in June. When you get to a point, though, when the cost of gain comes down far enough, which it is because of this break in the corn, and you get a producer that looks at the market and says, well, look at October is $3 more than August. If you were, say, in July or late in July, there may be some feedlots that may start to make a decision. Well, should I just make these cattle bigger? Should I feed them longer? Feeder cattle are very, very high to buy, hard to trade. Anyway, I don't want to be misunderstood. I'm very bullish, but I think that that's the thing in the intermediate term that we need to keep an eye on as hedgers of when we lose that edge, that currentness, that leverage, that word you use is the right word. Then we'd have a little different environment. We're at very, very high prices. Obviously, everyone knows that.
All right, we're going to leave on that note and catch up and see what happens in the next week, Brad.
Sounds good. Thanks.
All right, just a reminder, commodity futures and options do involve a substantial risk of loss, not suitable to all investors. And that's this week's Cattle Call on the Rural Radio Network.